Alright, welcome back to the Pool FX Forex trading course. So, now we're going to get into the guide to successful Forex trading with Pool FX. So, from here, I'll explain to you what Forex trading is and how to trade Forex. Pay close attention to this video, as this would form the basis of your trading. So, the first thing we're going to be starting off with is what is Forex trading? Forex or foreign exchange trading is the simultaneous buying of a currency and selling of another currency. These currencies are all traded in pairs, example Euro, USD, or Euro versus the United States dollar. Alright. So when saying that foreign exchange trading is the simultaneous buying of a currency and selling of another currency, think of it this way. Currencies are being exchanged every day all around the world. So when you travel to another country, you've got to exchange your currency in order to purchase things in that currency. So what you're going to do is you're going to go to an exchange facility, and if you are coming from Europe and going to the United States, you've got euros on you. So what you're going to have to do is you're going to have to sell your euros at the current price that euro is trading at, right? Current value of the euro, and for your €1 or certain amount of euros, you will then get a certain amount of dollars. So you would be selling your euro and you would be buying dollars or United States dollars. So that's basically what foreign exchange is in a nutshell. So let's get deeper into it, into what forex trading is, right? So the forex market has the most buyers and sellers than any other market in the world, and is traded in all major financial institutes around the world 24 hours a day, for 5 days a week. So the foreign exchange market exists in all investment platforms. So if you go to the bank and you want to invest into a certain portfolio, a percentage of your money would go into forex, because forex is a investment instrument, and they would then split up your money into various currencies within the forex market as well. That goes along with different stocks and everything else that you've got lying in your portfolio, or that your investment manager would be managing. So that would be that forex is traded in all major financial institutions. So that would be banks, hedge funds, and all those types of things, like I mentioned now, your investment funds, pension funds as well. Everything has forex in it, obviously along with stock trading as well. It says that forex has the most buyers and sellers than any other market in the world. So forex is the largest market in the world. It's multiple times bigger than the largest stock exchange in the world, and the most amount of dollars per day gets traded in the forex market itself. So there's plenty of money to go around to be made within the forex market, and the forex market is extremely liquid because of its high volume of traders, of buyers and sellers, which means that you can virtually get into the market at any time and get out of the market at any time. So, the buying and selling of currencies. Currencies in the forex market are priced and displayed in pairs, and when a trade takes place, it results in the simultaneous buying of one currency and the selling of another currency. The objective is to buy a currency that is increasing in value relative to the one that is being sold. When buying or selling a currency pair, you will then have to sell the currency or close the position to lock in the profits accumulated. So, we went over that currencies are bought and sold simultaneously. When trading forex, if you were to analyze a forex chart, you would see that if a chart is going up or increasing in value, and that chart, for example, is Euro USD, then the Euro would be increasing in strength relative to the United States dollar, which would then be decreasing in strength compared to the Euro. And over here it says that when buying or selling a currency pair, you then have to sell the currency pair or close the position to lock in the profits accumulated. What that means is that once you have entered a trade and the trade is running in profit or starting to make money, and you want to bank that money immediately, that money does not belong to you unless you actually close the trade. So what you're going to have to do is you're going to have to close the position, and when that is done, you are essentially selling that currency that you have been holding back to the market or selling it to another buyer in order to lock in profits. Right, so let's go on to the next one, reading Forex quotes. All currencies on the exchange is listed in pairs, example Euro USD, which we have been discussing now. The first currency in the pair is known as the base currency, which over here it says is Euro. The second currency is known as the counter or quote currency, example USD. All currencies are quoted using 5 numbers with the last number or placeholder called a pip or point. So over here we've got Euro USD, and we've got a price of 1.1325, and then we've got a price over here of 1.1330. So what it says over here is that all currencies are quoted using 5 numbers with the last number or placeholder called a pip. So the last number over here, which would be number 5, would be the pip, right, or a point in the market. So that's just a way to refer to the increasing and decreasing of the value of a currency, right? That a currency increases by 1 pip, 2 pips, 3 pips, or decreases by 1 pip, 2 pips, 3 pips. For every pip or point that a currency increases or decreases at, or not for any pip that it decreases at, but every currency's pip value is different, and there would be a specific value associated to the pips of a specific currency. So, for instance, if Euro USD or the Euro moves up by 1 pip, 1 pip for Euro would equal $10. So if the market was to move up, well, if Euro was to equal $10 per pip, if the market was to move up by 1 pip or point, you would then make $10. If it moved up by 1 pip or 1 point, sorry, if it moved up by 2 pips or 2 points, you would then be making $20. 3 points, $30, 4 points, $40, and so on. The same with if the market goes in the opposite direction of what you are trading, or if you are trading in the wrong direction and you didn't do your analysis properly, you would then start to lose money if the currency goes in the opposite direction. So if the market drops by 1 pip or 1 point, you would then be losing $10, so you'll be in minus $10. And if it goes down by 2 pips or 2 points, it will be minus 20. For 3 minus 30, 4 minus 40, and so on. Alright, let's go further. All financial instruments, including Forex, includes bid and ask, or buy and sell prices. When both the bid and ask get quoted in real time, brokers can be sure that traders always receive fair prices on their transactions. So what that means is the price that you will be seeing on your screen that shows this over here, which is your bid and ask price. This is the actual real-time prices of the currency within the Forex market. So obviously with my broker that I recommended, which is XM, they provide you with a real-time value of that currency, so you can be trading the actual prices that the currency is at the moment. Just like any other financial instrument, there is an immediate cost involved when opening up a buy or sell position. This cost is different across brokers and trading platforms and is known as the spread. So the spread is the difference in the actual value of a currency and how much the broker is charging you to purchase that currency from them. So as you see here with the example of Euro USD, we've got 1,1325, and then we've got 1,1330. So you can see the difference between these two values is 5 pips, because you can see we've got 25 at the end over there, 25, I can't highlight it exactly, and we've got 30 on this side. So the difference between 25 and 30 is 5. So that would equal 5 pips. So for you to enter this trade at this price over here, at the current market price, the broker will be charging you 5 pips, right? And that is how much how the broker will be making their money. So once you open up a trade, the trade will already be in a minus value because of the cost that you have incurred for opening up the trade with a broker. So as I explained at the bottom over here, spread is the difference you see between the bid and ask price. Example is exact example that I gave you over there, which equals 5 pips or a 5 pip spread. So that is the broker cost for taking part in the market or for trading that specific currency pair. So over here we've got Forex market locations. The Forex market runs 24 hours a day, 5 days a week, as I explained earlier. At 5 p.m. Sunday, New York time, trading starts as the Forex market opens up in Sydney and Singapore. Right, so if you are sitting in New York on a Sunday evening at 5 p.m., the Forex market will then be opening up in Sydney and Singapore, right? Because that would be the morning for them, where they would start trading, where the financial markets would then open up. Then at 7 p.m. New York time, the Tokyo market opens up. At 2 a.m. New York time, the London market opens. Then at 8 a.m. New York time, the New York market opens, right? So what this is called is different sessions. So when you are sitting in front of your PC and you are trading the Forex market will be open 24 hours a day for 5 days a week. Throughout that entire 24 hours, as the world turns and as different countries are awake and asleep, the different time zones would start operating or taking part in the Forex market. So obviously once it's nighttime in a certain time zone, those people will not be taking part in the Forex market, or those financial institutions would not be actively trading in the Forex market. However, the Forex market will still continuously run throughout that 24 hours where you can enter positions and exit positions. It's just to say that we will not have actual active financial institutions trading during those times, right? So we've got over here, it says, as a trader, this allows you to enter and exit the market at almost any given time, as the Forex market is open 24 hours a day, expanding through all the time zones and market hours. So that's just what I explained to you now. Forex trading takes place all across the world and is not located in any central location. Because there's so many different currencies and different countries worldwide, the Forex market is actually basically universal, right? And there's no central location for the forex market besides um, separate financial institutions where forex will be traded from, right? But wherever you are in the world, you would have access to the forex market because currencies are interchangeable and countries have to obviously work with each other. So that's what it means when it says that forex trading takes place all across the world and is not located in any central location. Then various deals or buying and selling of currencies is done between different banks, traders, managed investment or hedge funds, and individual retail traders like yourself. Right? Those are all the people that take part in the forex market or that are buying and selling currencies from each other. How big is the forex market? The forex market trades a huge average of over $5 trillion a day. Okay, that's not a typo over there. That actually is $5 trillion a day. That's how large the forex market is. It is by far the largest traded and most liquid market in the world, leaving us with endless opportunities to make money. Currency pairs. A variety of currency pairs can be traded, usually up to 28 pairs depending on your broker. So like we explained with the Euro USD currency pair, there are many various other currency pairs as well. Okay, of those you would then have your major currency pairs, so those are pairs that include the United States dollar, and that would be Euro USD, GBP USD, Australian dollar versus US dollar, US dollar versus Japanese yen, and US dollar versus the Swiss franc, okay, which is USD-CHF. Then we've got cross pairs and exotic pairs. Those are pairs that do not include the United States dollar. So for example, here we've got the Euro GBP, which is the Euro against the Great British Pound. Then we've got Euro JPY, which is the Euro against the Japanese Yen. We've got GBP JPY, which is the Great British Pound against the Japanese Yen. Euro CHF, which is the Euro against the Swiss franc. So those are cross pairs and exotic pairs. Please take note that when trading cross pairs and exotic pairs, the broker does charge you a bit more for trading those pairs. And like I explained to you previously, the charge that the broker charges you is called your spread. So if the broker is going to be charging you a bit more to trade these exotic or cross pairs, you would then notice that when you trade these pairs, there would be a much larger spread, right? So they would be asking a much larger price for actually taking part in the market and trading these pairs. Okay, then we've got major market players. So major market players that we've got are banks, governments, companies, reserve banks, large mutual funds, and hedge funds. Then we've got individual traders like yourself, right? So with banks over here, this would mean your small banks and your major banks, right? Governments, this would be governments that are buying currencies in order to do trades with other countries. The same with companies, those would be companies buying currencies or other worldly currencies. Not other worldly currencies, but currencies from other country in order to do trade with other countries. Then there would be reserve banks, right? Large mutual funds and hedge funds, which would be obviously taking part in forex trading in order to diversify portfolios and make profits off of forex trading, exactly the same way that you are trying to make profits off of Forex trading. We've got individual traders like yourself, which are called retail traders, right? And we're basically trying to do the same thing that these hedge funds and mutual funds do, but just on a smaller scale.